Imagine opening your brokerage app and seeing a small deposit not from your boss, not from a side hustle, but from companies quietly sending you money just because you own them. It feels magical. That's the promise of dividend investing. But magic always has fine print, and today we're reading it carefully. People talk about SCHD as if it's the golden goose of passive income. Buy it, hold it, collect quarterly checks, retire early, right? Not quite. The truth is softer, slower, and smarter than that story. And by the end of this video, you'll understand how SCHD can be both a gift and a trap, depending on how you use it. Let's start where most people stop with what SCHD actually is. SCHD isn't a lottery ticket or a secret millionaires club. It's a basket of large, mature American companies that have proven they can pay and grow dividends year after year. Think PepsiCo, Home Depot, Cisco, Coca-Cola, firms that make boring, predictable cash. They're the kind of businesses that keep selling whether the economy is booming or barely breathing. That's what investors love about it. Stability, simplicity, and that sweet promise of quarterly income. It feels like certainty in an uncertain world, but popularity doesn't equal protection. When something sounds risk-free, it often hides the risk in plain sight. Let's break that illusion. The yield mirage. When you hear 3.8% yield, it sounds like a paycheck, but a yield isn't fixed, it's a snapshot. When prices drop, yields go up, not because the companies are paying more, but because the math changed. If one of those companies cuts its dividend, and history says that eventually one will, your yield shrinks overnight. Dividends come from profit. When profits fall, payments follow. SCHD doesn't print money, it simply passes through whatever its companies can spare. So when people say dividends are passive income, remember, they're passive only if the economy behaves. Taxes, costs, and the hidden leak. Most investors quote the gross yield, "I make almost 4%. But after taxes, that number shrinks. If you're in the US, qualified dividends are taxed between 15 and 20%. If you're outside the USA, a withholding tax quietly takes its bite before the money even reaches you. Then there's the 0.06% expense ratio. Tiny but not zero. Add trading costs and the slow erosion of opportunity cost. Every dollar paid out is a dollar not compounding inside the business. And your 4% might really be closer to 3. Still good, but not the free lunch the internet promised. The growth trade-off. Dividends come from companies that have already grown. They pay shareholders because they've run out of big ideas. That's fine. Mature companies are steady, but it also means limited upside. When the tech sector soars, SCHD stays in its lane. You'll get fewer stomach-churning drops, but also fewer breathtaking climbs. Over 10 years, that gap compounds. Someone who split their money between SCHD and a growth ETF like QQQ may end up wealthier than someone who went all in on dividends. That's not a flaw in SCHD, it's the cost of stability. The illusion of set and forget. People love the phrase buy and hold. But hold doesn't mean ignore. Dividends depend on corporate health, and corporate health changes. Interest rates rise, industries shift, tax laws rewrite themselves. If you don't occasionally check your holdings, you might wake up to find your passive income isn't so passive anymore. Here's the quiet truth. Dividend investing is simple, not easy. Simple because the rules are clear. Buy good companies, reinvest, repeat. Not easy because discipline is rare. When the market dips, your yield looks juicier. Your brain whispers, buy more. But what if those yields are high because danger is near? A 7% yield can be a gift or a warning sign. The difference is usually debt. That's why smart investors don't chase numbers, they chase durability. They ask, can this company keep paying through bad times? Now let's zoom in on SCHD itself, what it owns, how it's built, and where the cracks hide. SCHD tracks an index of roughly 100 companies, but almost 40% of the money sits in the top 10. That means your diversified ETF leans heavily on a few giants, names like Chevron, Amgen, and Verizon. If energy tanks or healthcare stumbles, your whole portfolio catches the flu. The fund limits exposure, no single stock over 4%, no sector over 25%, but bias remains. And bias is fine, as long as you know it's there. Trouble starts when investors mistake rules for guarantees. What happens when the market turns? Many assume dividend stocks are safe during recessions. And yes, some are sturdier than flashy growth names, but when the tide goes out, everyone gets wet. Even the proudest dividend aristocrats cut payouts in past downturns. Safety in investing isn't about avoiding loss, it's about surviving it without panic. When the market falls, SCHD will too. Maybe less than QQQ, but it will bleed. And that's where psychology kicks in. because the hardest part of dividend investing isn't the math, it's the waiting. The dividends keep coming, slowly, predictably, while the price chart screams chaos. If you can keep buying through that noise, you win. If not, you become another cautionary tale. Let's pause there, because understanding these foundations is the first step. Next, we'll explore how to use SHD the right way, not as a mythic income machine, but as one component of a larger, resilient system that actually builds wealth. Imagine building a house where every brick earns rent. That's what smart dividend investing feels like when you do it right. And SAHD, it's one of those bricks, strong, reliable, but not the whole house. The biggest mistake investors make with SAHD is treating it like a complete strategy instead of a single ingredient. Think of it like the protein in your financial diet. It's solid and sustaining, but if all you ever eat is steak, you're missing the nutrients that help you grow. Smart investors pair SAHD with other funds that fill the gaps. They blend income and growth, stability and ambition. That's where the real magic of compounding begins. The power of blending. Let's say you hold two ETFs, SAHD for dividends, and something like SAHD or QQQ for growth. One gives you steady cash, the other gives you momentum. The beauty of this mix is that each side supports the other when the market shifts. When growth stocks soar, your dividend base keeps you calm. When growth stocks crash, those dividends remind you why patience pays. Imagine splitting a $100,000 portfolio, 60% in SHD, 40% in SHG. Over time, those dividends get reinvested during dips, buying growth while it's cheap. That's not luck, that's system design. This approach doesn't promise the highest yield or the fastest growth, but it smooths the ride. It's like driving a hybrid, not flashy, not extreme, just quietly efficient mile after mile. Reinvesting, the invisible accelerator. Here's the secret weapon almost no one talks about, the dividend reinvestment plan, or DRIP. Each time you get paid, your brokerage automatically buys more shares. You don't even notice it happening, but your share count climbs quarter after quarter. And when the next payment comes, it's slightly larger. That's compounding, invisible, patient, relentless. Most people underestimate it because it looks boring, but boring is what wins. You can start with small numbers, even a few $100s a month. At first, those dividends might not even cover dinner, but give them a decade, and you'll realize your money has quietly become an employee that never sleeps. The real meaning of passive. When people say passive income, they imagine lounging on a beach while their brokerage account fills itself. But the truth is, passive income starts with active discipline, automatic contributions, consistent reinvestment, refusal to panic when the market misbehaves. The most passive investors are usually the ones who worked hardest to automate everything early. They built systems that kept working long after their attention moved on. And SHD works best when it's part of that system, a reliable gear in a larger machine. 3 mindsets, 3 outcomes. Picture 3 investors. Mark invests only in SHD, Emily splits between SHD and SHG, Ryan combines SHD with bonds for safety. Mark's income looks great on paper, but his portfolio barely grows. Emily's wealth climbs faster because her growth ETFs catch bull markets, while SHD cushions downturns. Ryan's returns are slower, but his stress levels stay near zero. Different stages of life, different blends. If you're young and building wealth, growth deserves a bigger slice. If you're close to retirement, stability earns more weight. There's no single right answer, only the right balance for where you stand today. The safety illusion. SAHD picks strong companies, names that have paid dividends for at least a decade. But even great companies can stumble. Think of Verizon or AT&T. For years they looked unshakable, until debt and competition caught up. The dividends survived for now, but the stock prices limped. That's why it's not enough to chase high yields. You have to look for quality, companies with room to breathe even when profits fall. A healthy yield grows slowly but lasts longer. A flashy one burns bright and burns out. Growth inside the dividends. There's a quiet way to future-proof your income. Mix SAHD with dividend growth ETFs like VIG. SAHD gives you income now. VIG plants seeds for higher income later. It's the difference between eating your harvest and planting for next season. Over 20 years, that small difference compounds into freedom. Timing is a distraction. Everyone wants to know the perfect moment to buy. The truth? You'll never know. That's why dollar cost averaging works so well. You buy a little every month through highs and lows. When prices drop, your fixed investment buys more shares. When prices rise, you buy fewer. Over time, your average cost finds balance. This rhythm turns volatility into opportunity. It turns emotion into automation. It's not about guessing the market, it's about outlasting it. The quiet power move. Some investors use a small twist, pairing SCHD with covered call ETFs like JEPI or XYLD. Those funds earn extra cash by selling call options, trading some upside for consistent income. It's not for everyone, but it can smooth out returns, especially when markets drift sideways. A 70-30 mix between SCHD and JEPI can turn quarterly dividends into monthly cash flow, steady, predictable, and practical. The trade-off? You give up some growth. But for investors who value cash flow over adrenaline, it's a worthy exchange. The total return lens. Here's where many dividend investors trip. They measure success by yield instead of total return. A 4% yield with zero growth loses to a 2% yield with 6% growth. Dividends matter, but only as part of the whole picture. It's not what a company pays you today, it's what your portfolio becomes tomorrow. That's why SCHD works best when you see it as a base layer, not the finish line. In the next part, we'll go deeper into the psychology behind dividend investing, why so many people fall in love with passive income, how emotion can quietly sabotage returns, and how to build habits that turn patience into power. There's a reason people fall in love with dividends. They make the invisible visible. When a company pays you, it turns your patience into proof. It's one of the few parts of investing that feels real. But that feeling is also where the trap begins. People chase that comfort like a drug. They check their brokerage apps, waiting for the next payment, as if money itself could whisper reassurance. When you see dividends as security instead of strategy, you stop thinking long-term. You stop asking, is my wealth actually growing? And start asking, when's my next payout? That's the psychology that kills returns. The emotional cycle, it always starts the same way. Someone buys SCHD, sets the reinvestment on, and promises themselves they'll hold forever. Then the market drops. The yield looks better, but the price looks ugly. They panic. They forget the point of dividends, to stay calm through noise. Dividends are like trees. They don't grow faster when you shout at them. They grow when you give them time and protection. Every investor faces the same test. Can you stay steady when your balance dips, but your income doesn't? If you can, you're already ahead of most people. The mirage of safety. Dividends feel like safety because they show up even when the headlines are bad. But safety isn't a yield, it's a mindset. A 4% yield can be risky if it blinds you to opportunity. A 1% yield can be powerful if it comes with growth. The real safety comes from consistency, contributing through fear, holding through noise, and understanding that losses are tuition, not failure. Tracking progress the right way. Many investors measure success by portfolio value. That's a mistake. Price moves are loud, but dividends whisper the truth. A better way to track progress is to measure your income growth rate. If your quarterly dividends rise year after year, even slowly, that's compounding in action. It means your system works even if the charts don't look pretty. Here's a habit worth building. Once a year, record your annual dividend total, not the balance, just the income. Over time, that number will tell a story the market can't. It will show patience turning into power. Forecasting freedom. People love to ask how much money they need to make $1,000 a month. At a 4% yield, that's roughly $300,000 invested. It sounds impossible until you start. If you invest $1,000 a month and earn 8% a year, you'll reach it in about 12 years. The hardest part isn't the math, it's the waiting. The difference between the person who gets there and the person who doesn't isn't luck. It's the decision to keep going through boredom, through doubt, through years when nothing seems to move. Turning dividends into a system. The best investors treat dividends like a business. They track revenue, monitor growth, and reinvest profits. They celebrate small wins. When a quarterly payment grows by $10, they know that's proof of progress. Over time, those small wins stack up into something that feels almost unreal. You stop working for every dollar. The dollars start working for you. Imagine the moment your dividends cover your grocery bill. Then your rent. Then your entire life. That's not fantasy. That's math multiplied by time. The quiet joy of boring. When people talk about freedom, they picture yachts and palm trees. But real freedom often looks like quiet mornings and a balance that grows while you sleep. It's peace, not noise. Dividend investing teaches that lesson slowly. You won't get viral excitement or wild swings. You'll get discipline disguised as boredom. But one day, boredom turns into peace of mind. That's what SCHD gives you if you let it, not thrill but stability. not drama, but direction. And the longer you hold that direction, the more powerful it becomes. The long view. Markets will crash again. Headlines will shout. Some companies will cut payouts. But patience always outlasts panic. Every reinvested dividend is a quiet vote of confidence in your future self, the one who kept going while others gave up. Every dollar you invest today is a dollar buying you time tomorrow. Time to rest, time to choose, time to live on your terms. That's what passive income really means. It's not about escaping work. It's about creating space where work becomes a choice, not a demand. So keep going, keep building. Let your dividends grow quietly in the background. And remember, wealth isn't built in noise, it's built in patience. SCHD is one of the simplest tools to prove that truth, but it only works if you give it time too. The market rewards consistency more than brilliance. And in the long run, time makes everyone look like a genius who stayed the course. So here's the truth. Dividend investing isn't about chasing quick wins. It's about building something that lasts. SCHD is just a tool, but in the hands of a patient investor, it becomes a quiet engine of freedom. You don't have to be perfect. You just have to start, stay consistent, and let time do the heavy lifting. If this video helped you see dividends in a new light, give it a like. It tells the algorithm that calm, thoughtful investing still matters. Subscribe to The Passive Path for more stories like this, the kind that teach, remind, and ground you when the market goes wild. Leave a comment and tell us where you are on your journey. Are you just beginning to build your portfolio, or are you already seeing your dividends grow month by month? Your story might be the spark that helps someone else start theirs. And if you know someone who's been trying to figure out how to make their money work quietly in the background, share this video with them. You never know whose life it might change. Thank you for watching, and good luck on your own passive path. Keep learning, keep growing, and feel free to explore the other videos on this channel. Each one is designed to help you build the mindset and habits that lead to lasting wealth.